and this certainly ranges. I think there's founders that are solo founders, and so they're going to retain a much higher stake. There's management teams that have, you know, a CTO, a CEO, and a COO that all have somewhat commiserate amounts. Sometimes there's a vast disparity. That's something that we certainly look for. You know, we certainly don't want any of the key members to not feel incentivized, you know, and really motivated to continue to perform. I think a typical rule of thumb is per round, you're going to dilute yourself by roughly 20%. That's you know, kind of 15 to 25% is a fair range for, you know, how much you should raise as a function of the post money basis of your company and the dilutive effect there. I think a founder should have you know, kind of post Series A, you know, if they have, you know, a partner or two, at least 20% of the business. If it's just them, you know, maybe that can be higher, closer to 40%. It's important to keep in mind that if this is a business that is planning on exiting soon, like, you know, not every business turns into a multi-billion-dollar company. Like, there are several businesses that we invest into at, you know, valuations between 10 to 20 million that'll exit, you know, for somewhere between 100 to 300, 400 million. And those are certainly great outcomes for the entrepreneur, great outcomes for us. So I think if you're an entrepreneur that's not necessarily planning on raising too much capital, or if you're exploring other strategies like venture debt, which is starting to become a lot more common now, then that also impacts your ability to retain equity.